Good morning and welcome to the NEWRIVER REIT PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted any time by the Q&A tab situated on the right-hand corner of your screen. To click Q&A, simply scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and we'll publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Alan Lockhart, CEO, and Will Hopham, CFO. Good morning.
Thank you, Paul, and good morning, everybody, and welcome to our half-year results presentation and for taking the time to listen in. We're here in London. It's a very cold morning, but we're absolutely delighted to be with you. Before we get started, for those of you that don't really know us, NEWRIVER is a REIT. We specialise in the UK retail and leisure real estate sector. We have a portfolio of approximately £643 million, which comprises around 30 shopping centres and 15 retail parks. And we have investments in pretty much most regions of the UK. So let's get started with an overview. I'll just move on to thank you, Lucy. So we've had actually a very resilient operational performance in the first half of our financial year. Across all of our metrics, that sort of resilience has really come through, whether it is maintaining very high occupancy, high retention rate. In other words, when tenants come to lease expiry or break, the vast majority choose to stay within our estate because they're trading profitably. We've had a very good leasing performance now with both elevated volumes, but also we've been transacting our leasing terms at above value as ERVs and indeed above the passing rent. And our rent collection has also now normalised to a pre-COVID level. And we think our operational performance is really as a result of three things. Firstly, our portfolio positioning. Majority of our rental cash flows are derived from tenants that are focused on essential goods and services. And, that's a good place to be, particularly with the current economic environment. Secondly, we're able to offer space at rents that our tenants can afford, leading to good underlying profitability for our tenants within our portfolio. And thirdly, is just the quality of our asset management platform. We have a team that has a lot of experience and a deep knowledge of UK retail real estate. And our team have consistently executed very well, not just in the first half, but in the last sort of 2 to 3 years. And that quality of our platform was recently validated by NEWRIVER's appointment by M&G, a global real estate investor, to asset manage a very large retail portfolio comprising of around 16 retail parks and 1 shopping centre. Now, the good operating performance that we had in the first half, and indeed really for the last 2 or 3 reporting periods, has fed into some good financial resilience numbers as well. From our retail portfolio, the underlying funds from operation was up 77% compared to the comparative period last year, to £13.6 million. And indeed, our underlying funds from operation was higher than the second half of last financial year. And that's led to NEWRIVER declaring an interim dividend of 3.5p per share, fully covered, and represents a 6% increase on the last declared dividend. Our balance sheet is in great shape. We posted an LTV of just under 34%. We have no debt maturity on finance until 2028. All of our interest costs, which is currently at 3.5%, is fully fixed again to 2028. And we ended the period with around about 95 million of cash in the bank. So, operationally, it's been a very resilient period, and financially, we're in really good shape as we move ahead into the second half. Thanks, Lucy. So just quickly on our market backdrop, high inflation and rising interest rates have been impacting consumer spending, and will continue to do so as we move into 2023. But Notwithstanding that, at NewRiver, we feel that or see reasons to be reassured about our market positioning. Recent tax increases and reductions in public spending means that consumers will have difficult spending choices to make. But you can see on this chart on the data where the growth rate of non-essential spending is now increasing ahead of non-essential spending. And our portfolio, which is focused more on essential goods and services, clearly puts us in a better position to withstand some of the economic challenges that the UK is facing. And when evaluating the UK consumer, I think it's important that one considers that UK consumer savings are elevated. There is rising wage growth in the system, low unemployment, and of course the government's energy support package, plus inflation-linked increases to pensions and universal credit are helpful. Retailers are facing similar pressures, and you can see the impact of high inflation in the retail sales data, where sales by value is increasing, but volume is down. The significant increase in retail sales to the online channel during COVID has been unwinding as shoppers return to physical stores. We believe that really in a high-cost environment, omni-channel retailers are well placed to control online costs by utilizing their physical store network, which is why click and collect has been rapidly increasing and will continue to do so. By contrast, we're seeing that online retailers who are perhaps more vulnerable are struggling to cope with rising costs, especially given their lower operating margins. And I think it's also important to remember that when evaluating retailers over the last 3 to 4 years, we have seen significant restructuring in the occupational base with elevated retailer failure. But also that many retailers have been, over the last 5 years or so, have focused on right-sizing their portfolio and reducing costs. So as we move into 2023, which is very likely to be a challenging year, given the forecasts of a lengthy recession, we believe that store-based and omni-channel retailers are generally fitter, leaner, and more agile to navigate through what will be a difficult year. Now, one of the tailwinds for retailers next year is reduced business rates, and we're really pleased that the government once again froze the UBR rate. And for those ratepayers that will be receiving a reduction in their business rates, the government also announced that they will pass on that benefit immediately, unlike the old system when it was spread over a period of time. And this is going to be really helpful for retailers next year, given the elevated costs that they're seeing elsewhere in their businesses. In addition, the government announced new rateable values for all non-domestic properties, and you can see the real estate sector results on the slide. For NewRiver, our current estimated reduction is around 19%, which will be great news for our occupiers and will support the sustainability of our future rental cash flows. Next slide, please. Thank you. So I mentioned that we've had a very strong operational performance in the first half of our financial year, and we haven't seen any disruption in our leasing activities. However, we have seen wider disruption in the capital markets, and there's been overall within the real estate sector, there has been a decline in capital values. And this has been driven predominantly by the recalibration of property yields to the increase in gilt rates. For retail, where capital values have already been rebased over the last 3 to 4 years, the impact of yield expansion has been less pronounced, as currently retail yields provide a premium to the 10-year gilt. On the chart on the right-hand side, you can clearly see the higher the rates of inflation and the impact that is having on the MSCI capital returns over the last 3 months compared to the last 12 months. So the sectors with the largest decline in capital values from June to September are those sectors where the property yield relative to the 10-year gilt did not provide a sufficient capital return. Now, for NewRiver, our valuations have been, more resilient this year, and given that our current portfolio equivalent yield is around 8.7%, that represents something like about 550 basis points higher than the 10-year gilt. So we've been a lot more insulated in 2022, and we believe that our yield spread to the 10-year gilt will provide insulation as we move into 2023. So moving on to our operating performance, we have consistently for some time now expressed our confidence in the underlying resilience of our portfolio. And even through the sort of significant disruption of COVID across all operating metrics, our portfolio has been remarkably resilient, and the first half of this financial year has been no exception. As an example of our resilience, from April 2020 through to September 2022, we have undertaken long-term leasing transactions that total around £13 million of annual rent. And that equates to just minus 0.2% compound annual growth rate over the weighted average lease term for those previous leases of 9.8 years. And given the level of disruption within the retail sector over the last 5 years, from the growth of online retailing and COVID, our leasing performance over the last 2.5 years really demonstrates the underlying resilience in our rental cash flows. And we believe, as I said earlier, that our portfolio position focused on essential goods and services, where a physical store is vital to our occupiers, is the reason that we have delivered consistently high occupancy, high retention, and strong leasing performance over the last 2.5 years. Now, moving to our valuation performance. Thank you, Lucy. Overall, it's been broadly stable at just under minus 1.3%. Our core shopping centres and retail parks delivered capital growth of 0.2% and 0.5% respectively, reflecting stable like-for-like movements in both equivalent yield and ERVs. And reassuringly, we have now had 3 financial reporting periods of stable valuations in our core shopping centres and also our retail parks. The only part of our portfolio that has been impacted by high inflation and high interest rates was in our regeneration portfolio, which accounted for around about 80% of the modest £8 million of total portfolio decline. And this was really as a result of higher estimated construction costs, an increase in the assumed development finance costs, and a pullback in the residential forward funding market. Our workout portfolio, which only accounts for around about 14% of our gross assets, recorded minus 2.5% of capital decline, but that represents a material improvement from the first half of our previous financial year and indeed in the second half of last financial year. Now, we've always held the view that income returns over the long term are the key driver of total returns. And given our high portfolio yield of 8.7%, you can see the importance of that income return in our total return outperformance relative to the MSCI. Over the last 5 years, our retail parks have delivered a total return outperformance of 380 basis points, and our shopping centres a massive 740 basis points. And this consistent outperformance is due to our portfolio positioning and our laser focus on income returns. Now, moving on to ESG. We normally publish a full report on ESG at the end of our financial year. But in the first half, we were pleased that our progress was recognised by GRES with an improvement in our overall rating, which included a maximum score for social and governance. The quality of our governance was also recognised by EPRA, where we retained our gold award status, which means that EPRA recognises the excellence in the transparency and comparability of our environmental, social and governance disclosures. Now, for us to achieve net zero will very much rely upon mutual action by ourselves and our occupiers. The energy our occupiers consumes in our assets accounts for almost 90% of our total carbon emissions. And these are emissions that we have limited control, but we continue to develop our engagement with our occupiers to support alignment between our own climate ambitions and those of our occupiers. What's really pleasing is that more of our occupiers are committing themselves to reducing carbon emissions. And currently, 57% of our lettable floor space is occupied by retailers that have set emission reduction targets. So I'm now going to hand over to Will, who's going to take you through the financials.
Thanks, Alan, and good morning, everyone. I'm Will Hogman, and it's my pleasure to be taking you through our financials this morning, starting with the key highlights. And we've made a strong start to the year, delivering continued improvement in UFFO, which increased to £13.6 million during the first half, from £12.8 million in the second half of the prior year, and £7.7 million in the first half of the prior year, which is the retail comp stripping out the contribution from Hawthorn prior to its disposal. Because our dividend policy is linked to UFFO, this has led to an improvement in our fully covered dividend, which has increased to 3.5 pence per share, up from 3.3 pence per share in the second half of last year. We've seen resilient valuation performance, despite disruption in the investment and credit markets, leading to a stable NTA per share of 132 pence, which compares to 134 pence at the full year and 131 pence a year ago. This valuation performance, together with our fully covered dividend, means LTV now stands at 33.8%, down from 34.1% at the full year and 39.4% a year ago. Interest cover, which is another key debt metric, has also improved to 3.9 times, trending upwards from 2.7 times a year ago and 3.5 times at the full year, benefiting from continued income recovery and a reduction in gross debt, on which costs are fixed, which, along with the fact that we have no refinancing requirement until 2028 and access to 220 million of total liquidity, including 95 million pounds in the bank, means that we ended the half as we started it, in a strong financial position. I'll have more on the balance sheet later on, but first, let's take a look at UFFO. This time, alongside the usual UFFO statement, I've included a bridge from the first half of last year, which shows clearly that once adjusting for the contribution from pubs in the prior year, retail UFFO has improved significantly half on half, from £7.7 million last year to £13.6 million this year. And all component parts of UFFO have contributed to the increase. I'll have more on net property income, which has improved despite the disposals we completed in the second half of last year, in a moment. But before that, I'd like to walk you through the other drivers of the UFFO improvement, starting with other income, which you can see added 1.4 million. This relates entirely to the settlement of an income disruption insurance claim relating to our car park income during the first COVID lockdown between March and June 2020. You can see that our work on cost reduction, both admin and finance costs, added 4 million. With admin costs reflecting the impact of our cost-saving initiatives, not least the relocation of our head office, which we completed during the first half, and with finance costs benefiting from the debt restructuring exercise we completed last year. Next, NPI. which has increased from £25.2 million in the first half of last year to £25.7 million this half. And that's despite a £2.2 million reduction due to the 70 million of disposals we completed in the second half of last year. Like-for-like income was up by 0.6 million, a modest increase, but significant in representing return to growth after the declines we've seen in recent years. And importantly, like-for-like growth was strongest in our core shopping centre and retail park assets, which we see as forming the backbone of our portfolio in the long term. Rent collection rates have improved, and we've continued to collect historical rental arrears, which means we've seen a period-on-period reduction in rent and service charge provisions for a second successive year post-COVID, adding 1 million during the half. Lastly, car park and commercialisation income, which improved half on half last year and again in the first half of this year, recovering a further £1.1 million of income, and now back up to 80% of pre-pandemic levels. Next, I'd like to present a new bridge, which compares our retail NPI immediately prior to the pandemic, so the half year ended September 2019, with the half we're reporting today. I've included this slide because I think it's useful to look at how our income has improved, that has been impacted over the last few years, not least by COVID, and to highlight the resilience of our income and show how much of that disruption we've recovered. You can see that after adjusting for retail disposals over the last 3 years, we start in September 2019 with £30.3 million of retail NPI. Next, the buckets we've labelled as HY21 reduction. That's pre-COVID like-for-like decline of £2.2 million and COVID NPI impact, principally on rent collection and car park and commercialisation income. Then, recovery and regrowth in the 2 years that have followed, which encapsulates NPI recovery, i.e. the progress we've made in recovering the impact shown in the previous 2 bars. The gradual return to normalised levels of rent and service charge provisioning versus the elevated levels seen during the pandemic. The gradual return of car park and commercialisation income. And like-for-like NRI, which is stable, taking HY22 and HY23 together, but as you saw on the previous slide, trended positively in HY23. And lastly, the increase in our AM fees, which doesn't reflect the operating partner mandate we announced a few weeks ago, which means that our asset management fee income will increase going forward. So in summary, our income was disrupted during FY21, but we've made good progress in recovering that impact over the last 2 years. And we feel that underlying income is not only resilient at this point, but growing as we look forward. Lastly, before moving on to dividend, I'd like to break UFFO per share down into its constituent elements to look at the status and direction of travel of each. Starting with income, which, as I've just shown, was rebased during COVID and is now recovering. Then admin costs, which have already reduced and where we've targeted further savings. And finally, finance costs, which have also reduced and, very importantly in this environment, are fixed for the next 5.5 years. All of which means our UFFO is rebuilding, which flows directly into our dividend. Under our dividend policy, we pay dividends twice per annum, announced with our half and full year results, and based on 80% of the UFFO reported for the most recently completed 6-month period. So today we've declared a a few weeks ago we declared a first half dividend of 3.5 pence per share, which compares to the 4.1 pence declared in the first half of the prior year, half of which related to the pub business prior to its disposal. And more recently, 3.3 pence declared at the full year, which was our first dividend as a retail-only business. Moving on to the balance sheet, and starting with an overview of key balance sheet and debt metrics. I'll have more detail on individual metrics in the coming slides, but this slide shows clearly the strength of our position today and how that position has improved over the last 6 and 12 months, following the sale of the pub business and subsequent debt reduction completed last year. This position is supported by our cost of debt, which is fixed at 3.5%. And given we have no maturity on drawn debt until 2028, that will remain the case for the next 5.5 years. All this, and very importantly, our balance sheet remains fully unsecured. Next, net assets. And you can see from the slide that NTA per share reduced modestly from 134 pence to 132 pence during the first half, but remains ahead of the position a year ago of 131 pence, which is shown on the left-hand side of the slide. The key reasons for the movement in the first half were the UFFO we retained after the payment of dividends, which added 1.1 pence, offset by the modest 1.3% portfolio valuation decline. This translates to a total accounting return in the first half of 1%, and a total accounting return of 6.4% since September 2021, i.e. in our first 12 months as a retail-only business. I've also included a memo below the NTA bridge, which shows how LTV has changed during the half. And you can see it's reduced slightly from 34.1% to 33.8%. And the drivers are the same as NTA, with a reduction due to retained UFFO, offset by the impact of the modest valuation decline. Next, onto our financial policies, which form a key part of our approach to financial risk management. You can see clearly we have material headroom across all of our policies, and that our position has improved during the first half, particularly interest cover, which increased from 2.7 times a year ago to 3.9 times today. The key drivers of this improvement are the actions we completed during FY22, which can be seen on the slide, being the disposal of the pubs and the subsequent debt reduction, alongside the continued recovery of our retail income. It's worth noting that our policy is set at 2 times, and the covenant on our drawn debt is 1.5 times, meaning we have substantial and growing headroom against both of these benchmarks. And if we look at the 2 components of interest cover, we see this will continue to be an area of strength for us, with our income still recovering post-COVID and our low interest costs fixed until 2028. Next, onto capital allocation. To remind you, at the full year, with LTV at 34%, we said that we would not rush to redeploy to our 40% guidance level. But in the near term, we intended to keep some headroom and to operate with higher cash holdings, given the uncertain macroeconomic outlook. Looking back at the events of the last 6 months, we believe that this was the right call. Revisiting this position now, with LTV at a similar level to the full year, while we feel confident in the strength of NEWRIVER's position and the resilience of our underlying cash flows in this environment, given the macro outlook is arguably even more uncertain today, we do not believe that now is the time to reduce headroom. And we see no reason to change the near-term guidance we issued at the full year. We will continue to review this position as we make progress on our planned disposal programme, which has been challenging in the first half due to the impact of disruption in the capital markets on liquidity. And as we learn more about the potential impact of market disruption on valuations. But right now, we want to keep maximum optionality and flexibility. So we intend to keep headroom to the 40% level in the near term. Lastly from me, I'd like to expand on the key areas we expect to contribute to UFFO growth looking ahead. You can see on the left-hand side of the slide that we take the £13.6 million of UFFO we've reported for the first half and adjust it to remove the 1.4 million of COVID disruption insurance received in the first half, which related to FY21. We then annualise this, giving us 24.4 million as a start point. which compares to the annualized start point when we presented this slide 6 months ago of 17.6 million. With the increase because we've been successful in crystallising the growth from the right-hand side of the slide into our annualised start point. As you can see from the dashed box in the middle of the slide, which shows the progress we've made in capturing this growth in the first half. We then add in the savings we identified at our capital markets event in September 2021, which we've not yet unlocked, highlighted as number 1 on the slide. That's principally the further admin cost savings we've targeted on top of the 1 million of savings unlocked over the last year, which will be more challenging given the inflationary environment we're still in, but which will remain a key area of focus for us. Next, COVID impact, which is a measure of our success in recovering the income disruption we experienced during FY21. We made good progress during FY22, and this has continued in the first half of FY23, which means that the remaining impact to recover now stands at 4.2 million, down from 6.6 million at the full year. And we're confident we can make further inroads as we look ahead. But where we can't recover all of the lost income, we're actively expanding other revenue streams, such as our capital partnerships, where we've had success very recently in signing new and exciting operational management agreement with a leading real estate investor, M&G. Finally, number 3, surplus capital deployment. As I've just communicated, we will not rush to redeploy to the 40% LTV level in the near term. We've included an illustrative 64 million of acquisitions here at a 7% yield to give an indication of the optionality we have available to us. And in the meantime, we're making a return on our surplus capital by placing it on deposit. And we're currently generating a blended interest rate of around 3%. Thanks, everyone. And I'll now hand back to Alan.
Great, thank you, Will. And I'm just going to take you through the progress we've made on our key components of our portfolio. Starting with our core shopping centres, which represents about 34% of our total portfolio. And these are assets that are located in the heart of their town centres, and they continue to play a really important role in providing essential goods and services to their local communities. Our core shopping centres have been highly resilient, and that's really demonstrated in the operating metrics. And that's been the case even during the highly disruptive COVID period. Over the last 2.5 years, our occupancy has been consistently high, and retention rate for leases that are subject to expiry or break has also been high, and leasing terms versus ERV have been consistently positive. And this resilience is also reflected in our retail portfolio, which represents about 27% of our total portfolio, and which has had another good period of delivering strong operating metrics across our 15 conveniently located retail park assets. We continue to see strong occupational demand for our retail parks, which really demonstrates the attraction of these assets in terms of location, rental affordability, catchment, click and collect hubs, and in turn, retailer profitability. As a result, we're nearly fully let at 97%, and reassuringly, our retention rate is very high, reflecting the strong occupational demand that has been increasing over the last few years. Moving on to our regeneration portfolio, this is where we're seeking to deliver capital growth through redeveloping surplus retail space, principally for residential. Across our 3 projects, we're working on the delivery of over 1,700 residential units, providing a mix of build to sell, build to rent, and affordable units. Our regeneration portfolio valuation has been impacted by a combination of assumed higher construction costs, an increase in development cost financing, and a recent pullback in the residential forward funding market. But these are not projects that we would ever develop out ourselves. Instead, we can create value by securing planning consents, and then we have a number of options, including selling to specialist residential developers, as we successfully did with 2 of our regeneration projects last year in Oxford and South London. Now, whilst we continue to progress our development plans for our regeneration assets, we do receive an ongoing income return of around 6%. Now, moving to our workout portfolio, which represents only 14% of our total portfolio, and where we're seeking to exit through a combination of disposals and implementation of turnaround strategies to deliver long-term rental and capital sustainability. Now, whilst the recent disruption in the capital markets has impacted liquidity levels, we are currently under offer on £20 million of assets, with the remaining £21.5 million to be sold in our next financial year. We're well advanced with completing the turnaround strategies for 3 of our assets by the end of FY23, with the remaining 2 assets to be completed in the following financial year. And so our current estimate is that our workout portfolio will equate to around 8% of our total portfolio by the end of this financial year, and we should complete a full exit in the following financial year. And in the meantime, we benefit from an attractive income return and capital values that have really moved to a broadly stabilized position. So now moving on to capital partnerships, which is a key component of our business and one where we think we can really grow over the medium term. Capital partnerships really allows us to leverage our market-leading asset management platform and enhance our returns in a capital-light way through asset management fee income, as well as the potential to receive financial promotes. Post-period end, we were appointed by M&G to manage a large retail portfolio comprising 16 retail parks and 1 shopping centre for a term of 3 years. And we believe that that is a really strong endorsement of the quality of the NewRiver asset management platform. Our capital partnership with Bravo, which is the private equity arm of PIMCO, is performing well. And given the recent disruption in the capital markets, this joint venture is very well placed to capitalise on attractive opportunities that are likely to arise next year. We have a great relationship with Canterbury City Council, and we were pleased that our asset management mandate was extended to include their new leisure development in the city centre and our appointment as development manager for their planned city centre office development. Our strategic partnerships are a clear validation of our strong asset management capability and are likely to be an important source of new capital-light revenue in the coming years ahead. So, given the economic backdrop and that both the Bank of England and the OBR are forecasting a lengthy recession in 2023, albeit a shallow one, we've undertaken over the last sort of 2 to 3 months some stress testing of our portfolio to really try and understand what is the likely financial impact to NewRiver from a recessionary environment. So, we regard that the resilience of our rental cash flows is very much underpinned by the affordable rents and low occupational costs. And given the downward pressure on retailers' margins as a result of the increased costs and revenue pressures that they are facing, we have spent quite a bit of time assessing the rental affordability over the next 3 years. So we've worked with independent retail research consultants, and effectively what we've done is created a store P&L for everyone, well, about 98% of our tenants, and that's allowed us to forecast a range of outcomes both on revenue and costs. And when we talk about costs, we mean cost of goods sales, staffing costs, utility costs, and of course, obviously, the business rates revaluation. And then by assuming that our tenants want to maintain their net margin, we are then able to look at the relationship between what they can afford to pay versus, what they are actually paying. And today, we've obviously been enjoying a very good position that tenants can actually afford to pay more because they're profitable versus what they're currently paying us under the terms of their leases. As we move into next year, we can see that relationship slightly changes because tenants are facing increased cost pressures as well as sort of pressures around top line revenue. And that relationship slightly changes, but equates to only £600,000 of rent. And actually, when we match up our forecast leasing events next year, in other words, tenants that have a lease expiry in 2023 or a break, that group of tenants still has good affordability metrics. In other words, what our rental affordability analysis is telling us next year is that our tenants can still afford to pay the rents that they're contracted to pay, notwithstanding that cost pressures have increased and revenue pressures are there for next year. And then by 2024, that position reverts. And when we get to 2025, we're back into very positive position, higher than we're currently today. And part of that difference between 2025 and today is the impact of the reduction in business rates. But not all tenants have the opportunity to renegotiate their lease terms next year. So we've looked at underlying income security. How secure are our rental cash flows? Again, so we've done some stress testing here. We've worked with an external firm called Income Analytics that provide a projected probability of tenant failure looking ahead from a 1 year out to a 10-year period. And as you can see in the left-hand dotted box, over the next 2 years, which is going to be a challenging year in 2023, you can see that the projected probability of failure rate for our portfolio is by tenants is only 0.9% weighted by rent. And we're able to then translate that into a financial number, and the result of that financial number is that it's not material. Now, this is quite new stuff we've done here, so we thought it would be useful just to put it into context with the wider market. Income Analytics is partly owned by the MSCI, so you can see NewRiver's portfolio failure rate relative to the MSCI industrial sector and the MSCI office sector. And you can see on the dotted rectangle at the 5-year period, you can see how industrial and offices have a marginally better failure rate than our own portfolio. But you can see that in terms of the equivalent yield spread, our investors are more than compensated by having that significant yield spread. So what this stress testing is really telling us is that we think that our rental cash flows are going to be resilient into 2023, which we know is going to be a challenging year. So just to conclude, we've had a very resilient operating period in the first half, and that's really been a continuation of a really good recovery out of COVID. Our balance sheet is in really good shape with low leverage, long-term debt maturities, all of our interest costs fully hedged. But we also have a lot of optionality because we have around 95 million of cash in our bank accounts, as well as having further liquidity beyond that. So we're in a really good place. We know the next year is going to be a relatively tough environment, but all of our stress testing and analysis is suggesting that we should be pretty resilient into next year. And as Will covered off that, in one of his slides, we've got clear levers to generate future earnings growth from deploying capital in next year, as well as significant potential of growing our capital partnership business over the coming years. So I think we shall probably finish there and move now to Q&A.
That's fantastic. Thank you very much indeed, Alan. And thank you for the presentation to you both. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have had a number of questions that have come through today's presentation. So if I may just hand back to you just to read out the question where appropriate to do so and give your response, and I'll pick up from you at the end.
Yes, thank you. Well, let's go to the first question from Paul B. There have been media reports of forced sellers in the UK property market, including UK pension funds and open-ended property funds. Have you seen evidence of this? And is this something NewRiver can take advantage of? Yeah, there are definitely some UK open-ended property funds that have come under some recent pressure and are looking to provide greater liquidity in their funds, which is leading to them looking to dispose of certain assets. We're monitoring the market very carefully. The good news is that we put ourselves into a position where we have that flexibility in our balance sheet that to take advantage where we see opportunities. We also have the joint venture with our friends at PIMCO to provide further liquidity, and that's a great vehicle for us because we have a lot of flexibility as to the level of co-investment that we have to put in. But as Will said, right now we think that balance sheet strength and optionality is important to maintain, and although we believe that our rental cash flow should be really resilient into next year, we think it will be important for us to have a little bit more visibility on valuations as we move into 2023 and make more progress on some of the disposals that we are undertaking. This next question. How much, and this is from Matthew R, how much of the available liquidity do you expect to deploy in the next year, and what return profile? Do you want to take that question, Will?
Well, I think it's linked to what you've just said out, which is basically, the guidance that we gave out when we presented our results a few weeks ago was that we want to keep some headroom to our LTV guidance in the near term. And I think really what that means is that future deployment will be funded from kind of the disposals that we have underway at the moment. So I could see, if you just move up slightly, Lucy, it's obviously the question. I could see us holding a higher level of cash and liquidity in the near term, and actually, because I think we'll be keeping quite a lot of that available liquidity. And in terms of return profile, Alan?
Well, we're in the business of delivering the best risk-adjusted returns, and I said at our capital markets event in September last year when we'd undertaken a very detailed assessment on UK retail real estate to really find the assets in the UK market that today's rental cash flows are really resilient and will still be resilient in 10 years' time. We feel the greater number of opportunities of assets that will deliver that is within the retail park sector. So over the medium term, we do expect that our composition of our portfolio will change, and that in 4 or 5 years' time, retail parks will probably represent around about 50% of our portfolio composition.
Okay.
So we're going to move on to, hopefully that answers Matthew's question. We're moving on to Mark A's question. I'm interested to understand the potential with the capital partnerships and the associated fees. How much of this type of business can you manage? Well, as I've mentioned, Mark, we see a lot of growth potential in our capital partnership business. At the moment, we have 3 sort of key mandates and sort of what we would regard as 3 different types of investors. We've got a public sector mandate with Canterbury City Council. We think we can grow our activities within the public sector. We have our private equity mandate with PIMCO, and you know, we believe that that can grow in the coming years. We're not exclusive to PIMCO, so we have the ability to operate with other private equity partners, and now we have a major institutional mandate through M&G. And you may recall, I think it was back in 2019, we were talking about capital partnerships, and that we felt that over the sort of 5-year period, we should be able to grow that business to somewhere between 3 to 5 million of recurring earnings. As it stands today, we're close to the bottom end of that range, so we're achieving our targets, but probably in a faster time frame. And we believe that this is an area of our business that we can grow in the coming years. So I think it's going to be an increasingly important part of our business. So next question is Vivek. As the company is trading at a material discount to NAV with a lot of liquidity and healthy balance sheet, would the board consider a tender offer, share buyback to return capital? The discount would indicate a near double-digit equivalent yield on own shares versus its investments. Do you want to pick that up, Will?
Yeah, and I think the short answer, Vivek, is yes. So on slide 19 in the pack, what we said was, when we were talking about capital allocation, was that at the moment we're going to keep some headroom to our LTV guidance in the near term. But as and when we decide to deploy capital in the future, we have a flexible approach. We have really 3 key areas that we can deploy our capital. We can deploy it into our existing portfolio. For example, we spent around £2 million during the first half on kind of accretive capex across the portfolio. We can buy assets in the direct market. Alan's talked about, our preference probably for retail parks looking ahead, or we can buy our own shares. So the answer is, Vivek, as and when we decide to deploy capital, yes, we can deploy capital into a share buyback. In terms of which of those 3 places we will deploy our capital, what we'll do is we will look at the risk-adjusted returns attached to each of those 3 options, and we will make a decision based on the best return we can get.
Thanks, Will. So next question is from Nick S. Are you fitting energy-saving devices such as solar panels? Well, Nick, I mean, we started putting in solar panels probably about 10 years ago, and we're looking to add to that, as well as installing a lot of EV charging points. Already, all the energy that we supply to the common areas within our portfolio, in other words, the malls, the car parks, in terms of sort of lighting energy and heating, etc., is all from renewable energy. And all of the energy we provide our common areas, importantly, it's fully hedged out till spring 2024. So we're not being impacted by the significant increases in utility costs. Yusuf S. Hi, Yusuf. What is the magnitude of AM fees you project for FY 23-24? Can you give some idea of the scale of fees? Will, do you want to take that question?
Well, I think the way that I'd answer that is when we stood up at FY 22, so when we're reporting the year results for the year ended March 22, we had 1.9 million of AM fees. And really what we said about 3 or 4 years ago now was that our target was to get to 3 to 5 million of recurring AM fees. And I can see us kind of, as Alan said, we're getting towards the bottom end of that range. So, I would say really that the level of AM fees looking ahead is going to be somewhere between into FY 23 and FY 24. We'll just be trending up towards the bottom end of that range, really, that 3 to 5 million range.
Okay, thanks, Will. We've got a question from Mark S. Can I see it? Lucy? What effect has the property fund closures of the likes of Aviva, M&G and L&G had on your share price? Also, the recent disposals caused by the collateral call, caused by the forced collateral calls on the LVI disposals. I wouldn't say there's necessarily been a correlation on our share price, relative to the property fund closures, Mark. I think what's really impacted share prices in the real estate sector has been rising gilt rates. And you may recall we had that earlier slide where we were showing the capital return performance over the last 3 months versus the last 12 months. And it's really the sectors that have been hit the hardest, which is long dated income and the industrial sector, where their yields relative to the 10-year gilts were not providing sufficient risk premium. And because of those yields being expanded out, this is why you've seen in the overall real estate sector a very significant sort of downgrade in share prices. The reality is NewRiver this year has probably been one of the top performing share price relative to others in the sector. And I think that reflects maybe a few things. One, the fact that retail sector and indeed NewRiver, we've not been immune to, but the retail sector has already had very significant valuation rebasing and indeed rents rebasing over the last 3 to 4 years. So that yields had expanded out quite considerably and were offering a sufficient risk premium even whilst gilt rates were increasing. So, I think that's been a factor for why NewRiver has performed well relative to others. Is there anything else you want to add to that?
No, I didn't. So that's great.
Okay. Any other questions?
There's one more question from Yusuf, actually. I think he had two questions. So he says, are you seeing a reduction in cap rates as gilt yields stabilized and declined post the mini budget turmoil?
I think what we're seeing is a little bit more liquidity coming back into the market. There was no doubt that really liquidity within the real estate markets and retail sector wasn't immune to this. Really started to withdraw around about August, coinciding with the political instability, and then the sort of the fiscal event in September. But as things have started to stabilise and a little bit more confidence in the new chancellor and the budget, we're starting to see that liquidity coming back into the market, which I think will be helpful as we move into 2023.
Fantastic. Alan, Will, you've actually covered off every single question, so thank you very much indeed. And of course, if any further questions do come through, the team will have the ability to review those, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Alan, if I may, just before redirecting investors to provide you with their feedback, I know it is particularly important to you, if I could ask you just for a few closing comments, please.
Well, thank you everybody for taking the time. Hopefully, what came across to you is a business that, in many ways, has been sort of transformed over the last 3 years, particularly through the sale of our pub business. That's allowed us to significantly, strengthen our balance sheet. The business is in very good financial shape with a lot of optionality. We believe that we're one of the leading asset management teams in the UK retail real estate market. We have a lot of growth potential in our capital partnerships, underpinned by a portfolio that has been proven to be very operationally resilient over the last 2.5 years. We know next year is going to be a tough year, but it's not the first time our business has had to face up to challenges. As I said, we're a very battle-hardened team, and all of our stress testing, all of our scenario testing is suggesting that we should be pretty resilient as we move into 2023 but with a lot of optionality as to how we can really grow the business going forward. I think that's it. But thank you very much, everybody.
Fantastic. Alan, Will, thank you again for updating investors today. Can I please ask investors not to close the session as we automatically redirect it to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of NewRiver REIT PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good morning to you all.